Right. So basically what we will think is that U.S. consumers will be affected to the point that these tariffs on the 200 billion are increased. However, this 200 billion list does not include as much of consumer goods. So we think that in the U.S. we will see a minimal increase in U.S. prices, perhaps of about 0.03 percentage points this year.
So minimal increase in prices. What's the hit to global growth?
The hit to global growth is basically a decline of about 0.02 percentage points over the course of 2 to 3 years. But this is just without considering any potential feedback on financial markets or on market sentiment.
But overall, when you give us those statistics, albeit clearly they're estimates, it could be a bit worse than that, I'm thinking, why doesn't he increase those tariffs? Because it's not that big a hit, and it's presumably quite a strong bargaining chip.
Right, and basically Citi's view is that the relative growth dynamics between the US and China is something that is going to have a major role in these negotiations. Right now the US economy is super strong, markets are close to historically high levels, and the Chinese economy is now stabilizing. But our projections show that for the next quarter and for the second half of this year, that will change as the stabilized economy in China and a moderate growth in the US change the leverage in this administration. So, as you mentioned, the moment is now to have that leverage. Perhaps it will not be as strong as it is now unless we have a trade war tomorrow.
So, Barry, I mean, what kind of calculus do you make as an investor, given that that threat hangs over the market?
Yeah, my perspective on this is that, and we wrote about this a couple of weeks ago, that we're likely to get a deal. And I would forget about President Trump's motivations or the U.S. motivations. Sure, get a deal. The costs are not all that significant right now. They can be borne mostly through business confidence measures. We did have hits to business confidence last spring when the trade war began, again in the fall when the threat of tariffs emerged. It will clearly impair things like investing in structures, physical plant, that sort of thing, which is so confidence-based. There's a cost, to be sure, but the real reason that a deal gets done is because it's a benefit to China. I mean, they've had 2 big malinvestment busts in the last 5 years. They're heavy industry, steel industry, cement, and all from 14 to 16, and now their export sector. They need to restructure away from state-owned enterprises. The economics of them providing intellectual property protection are compelling. If they want to actually avoid the middle income trap and move forward and have true innovation in their country, they need to protect their own innovators. So I think that calculus is clear. The political part of this is a little more difficult for China because giving up control over state-owned enterprises, actually emphasizing the private sector, means you lose a level of political control. And that, for China, is the tough political calculus.
And Barry, with all that in mind, you think people should avoid both Asian and German equities?
Yeah, my broader point here, and I'm glad you brought me to it, is that the secular headwinds are in the face of global trade. Global trade ran at 2.5 times GDP in the 2000s. It's only running at GDP this cycle. Globalization is no longer expanding, nor is it likely to. The model is to manufacture where final demand is. So if you looked at Chinese trade numbers last night, for example, they are very tepid. The recovery is very tepid. It should be strong. Korea, same story. Taiwan, same story. Japan, same story. So what we think will happen is you'll get a deal, you'll have euphoria, but the other side of that deal will be very disappointing in terms of the implications for global growth in the near term. Might be good for China structurally in the long term, but in the near term, you won't get the big recovery and growth. And as a consequence, those countries that are really dependent upon exports, Korea, Japan, Germany, China, are going to disappoint, and investors should probably cut exposure on those, particularly if you get a euphoric rally in those equity markets.